All right, it looks like attending numbers have stabilized. So thanks once again for joining us for the Ocean and Air Freight Tracker Outlook webinar for Q4 2025. Um, this will be our last webinar of the year. We'll be talking about how peak season has been going so far, and obviously looking ahead at the outlook for 2026. I think it's been another interesting period. Of course, last time we talked a lot about how the trade situation had actually been perhaps better than we expected in the first half of the year and how that was sort of changing the outlook, although we saw there was still quite a lot of front-loaded volumes in the first half of the year. And I think we're still seeing an improvement really now in the trade picture overall, with the agreement anyway in Asia between the US and China on trade, which has relieved some of the issues around fees and so on. So volume picture from a trade point of view looking a little stronger perhaps. And also with the opening or potential opening of the Suez Canal, I think some of the challenges with capacity and disruption, may be easing, but of course that's very uncertain. So, a few things to talk about, and obviously we'll discuss how that affects ocean versus air freight as well, and those kind of dynamics too today. As ever, the session will be about 30 minutes. We'll spend about 15 minutes on ocean freight and 15 minutes on air freight after that, and then we'll have a Q&A session. So please do feel free to ask your questions using the Q&A app throughout the course of the presentation. Please also note that we'll be running a couple of polls when we talk about the outlook for the next quarter. So we'll take you through the results of our quarterly survey on, or actually our weekly survey, I think, on ocean and air freight rate expectations, and then we'll ask you for your input as well. So be prepared to answer those polls as they come out. There'll be about 15 minutes and half an hour into the presentation, respectively, for ocean and air freight. We will send out copies of the reports to all attendees after the session. So obviously, we'll try and cover as much as we can during the webinar. But if you need more detail, then you have the detailed air and ocean freight reports you can download. And of course, if you want even more detail than that, you can download the full reports by lane from TI by subscribing to GSCI. And we'll be happy to discuss that with you, as well as getting access to the underlying data as well. So I'll start the session now by introducing our panelists. So we're joined once again by Janan Hassan, who's one of TI's data analysts and who leads the data work for these reports. So welcome, Janan.
Thank you, Michael. Hi, everyone.
And I'm very pleased to welcome back Vicky Kekarovska, who's our research manager here at TI and oversees a lot of the qualitative work we do here in primary research, and one of our subject matter experts on air and ocean. Vicky's been on maternity leave, but we're working her back today. So welcome back, Vicky.
Thanks, Michael. Hi, everyone.
Brilliant. Okay, so we'll move on to our first section today, which is on ocean freight, and we'll start off by taking a headline look at the global picture for ocean freight rate development, and Vicky's going to take us through the trend here.
Thanks, Michael. So yes, we're looking at TI's Global Ocean Freight Rate Index here, and you can clearly see falling ocean rates this quarter. We've seen a big temporary spike in May and June, and we know this was mainly driven by the front loading that took place ahead of the tariff changes. But since then, since July, ocean freight rates have been on a downward trend. In October, for instance, both the backhaul and headhaul in the index were at the lowest level in almost 2 years. And all trade lanes that we cover in the tracker saw falling rates. The Trans-Pacific one experienced the sharpest fall of 60%. But then the Asia to Europe lane also experienced a significant fall of around 50% compared to the year before. And several factors have contributed to this. The main ones being US tariffs and overcapacity in the shipping market. So yeah, these falling rates do represent an opportunity for shippers to review their contracts, to renegotiate freight contracts, to potentially lock in lower cost, lower rates for the year ahead.
Fantastic, thank you, Vicky. So an interesting period. It'll be interesting when we get to the outlook section to see how long we think that may last as well. All right, so that's rates, but now we'll take a look at the volumes and underlying demand picture as well. So would you take us through this one too, Vicky?
Yeah, so as you mentioned at the start, in terms of volumes, we're seeing a positive development. We can see that volumes have been gradually picking up quarter on quarter. and the strongest performer in terms of volumes is America. So the volume index in North America increased by 12% quarter on quarter. But that's not the case with Europe. You can see a flat line here on the chart, and this has been mainly driven by sluggish consumer demand and relatively downbeat consumer sentiment across the continent. And then in Asia, port volumes have been growing, but we're seeing mixed performance here. In China, for instance, growth is slowing down. Retail sales are much weaker. But then on the other hand, we've got Southeast Asia, where volumes are growing significantly. And this is primarily driven by strong e-commerce sales and supply chain diversification away from China. But yeah, overall, the volume development is generally positive. It won't be as strong as it was during the summer months when shippers were pulling forward inbound goods ahead of the tariff changes.
Hmm. Yeah, it's interesting. I mean, anecdotally as well on volumes over this sort of peak season, I hear from various retailers that it's been quite a slow start to peak season,
Yes.
but picked up a bit in November as well. So, I mean, that doesn't tell us much about the ocean freight market. Of course, the goods have already arrived, but the looking at the outlook, we may see that we actually have a bit of an overstock situation after this peak season if retailers may have over ordered sluggish demand. So that might be something to think about as well as we head into 2026. But perhaps we can come on to that in the outlook section too. Um, so that's the demand side, but obviously we also want to look at supply side issues, and capacity has been very interesting in ocean freight this year as a key challenge, really. So, Janine, can you explain what's going on in ocean freight capacity on a global level for us?
Of course. So here we're seeing a fascinating paradox. Capacity increases but softening rates. Month on month, though, there was a drop of 20% in total TEUs compared to September, and that effect was largely seasonal as a lot of inventory replenishment took place in Q3, and capacity is slightly down 2.7% in Q3 compared to last year. And that's on available capacity being used at the moment. But in terms of actual fleet numbers, the global container fleet is now 7.6% larger than it was a year ago. And that's substantial growth. So, what's driving all this capacity growth? First, new vessel deliveries are flooding the market, and we're talking nearly 10 million TEU on order, and that's roughly 30% of the entire global fleet. Second, not a lot of ships are being demolished. In normal times, older vessels would be scrapped, creating natural capacity constraints. That's not happening largely anymore. And third, there's not a lot of inactive capacity, and ships aren't sitting idle and they're out there operating. Hapag-Lloyd ordered 24 new ships at the end of last year, and Maersk just announced orders for at least eight, possibly 12 new 22,000 TEU mega vessels from a Chinese yard. And there's a record worth noting. MSC now operates a fleet of 7 million TEUs, and that's the largest fleet any single operator has ever controlled.
Hmm. Yeah, so that's interesting rising capacity there. And obviously, one of the features of this year has been capacity kind of effectively taken out of the market for redirections around the Suez Canal. So again, when we come to the outlook section, perhaps we could talk about what that might mean and if that's likely to lead to then an even greater capacity or excess of capacity if those routes are shortened by opening Suez again. All right, so that's one aspect of the supply side, but obviously we also want to look at underlying costs as well, and fuel always an interesting driver of rate development. What's the latest on fuel prices, Janine?
So, fuel prices tell us a lot about the current operating environment and ultimately what shippers can expect. Globally, bunker prices are down 16% year on year. And looking at the regional breakdown, prices in the Americas are declining the most by about 20% versus last year, although it remains the most expensive bunker market globally. US oil inventories are rising, and that's building real price pressure. Quarter on quarter, global bunker prices are down 3.4%. Overall, 2025 has been a year of volatility, geopolitical instability, trade tension, and economic uncertainty. So, all of that has created real turbulence in the oil sector. In Q3, supply started catching up with demand and prices began softening. On the demand side, we're seeing weaker crude oil benchmarks, which directly impact bunker fuel prices. And global shipping activity, particularly container and bulk from Asia, is showing signs of slowing, as Vicky said. On the supply side, refinery output has improved and bunker fuel availability is better than it was earlier this year.
Brilliant. Thanks, Janam. Okay, so we'll now move on to our first sentiment index. So this is our ocean freight sentiment index, basically measuring how respondents expect rates to develop in the next quarter. And we're going to run a live poll for you today as well, asking what you think is going to happen over the next 3 months as well. So you should see that popping up on your screen. Please have a look and answer as you think. And while you're doing that, Vicky will just talk through what the data here shows from our latest survey. Go ahead, Vicky.
Yes. So globally, the poll data shows that we are supposed to expect a generally positive outlook. So around 53% of poll respondents expect ocean freight rates to increase in some way over the next 3 months. And the Asia to Europe trade lane is worth highlighting here. So in Q4 this year, the sentiment on this route continues on an upward trend. 56% of respondents expect rates to rise on this lane in the next 3 months, and we've seen this trend in the previous quarter as well. And then on the Asia to North America route, the sentiment is quite mixed, and the results are almost evenly split. So we've got 45% of participants expecting an increase and 43% that expect a decrease. Again, a continuation of the trend we saw in the previous quarter. So I think it just reflects the volatility and uncertainty that we're seeing on this trade lane.
Absolutely. Well, we've had our responses in, so I'm just showing the poll results as well, so we can see what our participants think today. And interestingly, 59% on decrease slightly, so a little different in
Yes.
sentiment
Yeah.
from our latest poll data in the big survey. But perhaps we've just been talking so much about overcapacity that we've shaped our listeners' thoughts there. But what's your thoughts on that, Vicky?
Well, I think it varies so much by trade lane. Like we've seen a lot of variation over the past few quarters, mainly because of the trade uncertainty and the tariff changes. So I think it will really depend on the trade lane.
Mm.
But also there are so many developments to monitor. You mentioned the reopening of the Suez Canal. Then we've got some new trade regulations from the EU that have been announced. So yeah, lots of things to monitor in the year ahead.
Yeah, and to factor in. So it'll be interesting to see how that develops. So thanks for participating in that poll. And we also want to take you through our outlook as well for the year ahead. So of course, part of the exercise with these reports and this webinar is to show our expectations for the year ahead. And actually, the sentiment index is quite important in helping shape that, so we can understand the market view as well. But this outlook grid here basically summarizes TI's expectations for rate development over the next year or so. Basically, the chart shows right at the bottom there are overriding expectations for rate development, and then each of these rows shows the different factors which are considered when making this calculation. And the arrows show the effect of that metric or measure on rate development. So they show the direction the measure itself is going, but how it will affect rates. So that's how that works. And as you can see, our expectation is for a decrease, obviously this quarter from the data we see so far for Q4, and for Q1 2026. So that is sort of in line with all of your expectations from the poll just now. But it's interesting to dive into what's driving that. So first of all, I'd ask Vicky just to comment on maybe the key sort of demand side factors which are driving that rate outlook for us.
Yes, well, in terms of volumes, the outlook is moderate because peak season cargo has already been delivered. So volumes in the last quarter are likely to be soft. And as Janan pointed out earlier, we've got inflation, economic volatility that all threatened to dampen consumer spending into the year. And as a result, we should expect a slower finish to the year. And then with regards to inventory levels, again, these are putting downward pressure on rates because retailers still carry excess inventory and they have started aggressive discounting quite early ahead of the Christmas season. And this obviously reduces inbound demand. So overall, retailers will continue to manage stock quite conservatively. So that means we will see gradual restocking rather than aggressive restocking in 2026.
Okay, thanks. Thanks, Vicky. And Janelle, what's the key supply side issues which are driving this rate outlook?
Thanks, Michael. So in the near term, ocean freight overcapacity will continue, and therefore rates are going to continue softening, and that's due in part to seasonality as well. There's multiple factors at play here. Some of them are supplier price power and strategy that suppliers try to employ in these times is usually blank sailings, and that could play a part in the coming quarter. There's also a wild card that could accelerate this decline even further, return to the Suez Canal in 2026. So if major container lines resume using that route, we could see rates drop even more sharply than currently anticipated, and that's something to watch closely in your planning. And on the bunker fuel side of things, OPEC is predicting that global oil demand will rise next year by 1.6 million barrels per day, and that would definitely put upwards pressure on operating costs.
Yes, thanks, Shannon. Okay, so very interesting picture overall for ocean freight. We're now going to turn to air freight, and we'll follow the same structure once again. So first of all, we're looking at air freight rates development, and Vicky once again is going to take us through what's been going on with air freight rates.
Yeah, so if we look at the index numbers on a monthly basis, we can see there has been a slight uptick in rates in October and November. So they have been trending upward month on month. But compared to the previous year, both head haul and back haul air freight rates decreased in November compared to the previous year. And if we take Q3 as a whole, we're seeing rates that are lower compared to last year. And this was mainly influenced by capacity slightly exceeding demand in the air cargo market and volatility rising from the US tariffs, and in particular, the elimination of duty-free imports. But then we've also seen higher volumes on other trade lanes, including imports into Europe. So these higher volumes contributed to more stable market conditions and less significant rate movements.
Yeah, thank you, Vicky. And if we look then at the underlying demand picture, what's the latest trend there?
Well, the volume index reflects the general sentiment that Q4 demand will soften compared to the previous quarters, and we should not expect a strong peak air cargo season because we did have a very strong summer in terms of volume growth. So the momentum has moderated and volumes are stabilizing. And then the industry as a whole is experiencing a notable shift in trade flows, in demand patterns. And we know, and we've talked a lot about, volumes reducing from China into the US as a result of the tariff changes, but other trade lanes have gained market share, for instance, China to Europe and intra China. And several verticals are driving this growth, including e-commerce, very strong contributor, but also pharmaceuticals and electronics as well.
Yeah, absolutely. And I suppose, I mean, one of the things we won't perhaps see if we've got a weak peak season is any sort of emergency or un unplanned shipments by air to bring stock in if we already have an oversupply situation. So um, maybe we don't have that pressure either this quarter. All right, so that's the demand side, and we'll turn now to capacity. So, we talked a lot about what's going on with oversupply in ocean freight. What's the story in air freight, Janan?
Thank you, Michael. As we can see here, global cargo ton kilometers and available cargo ton kilometers are both up 4.8% year on year for Q3. Month on month, though, CTK growth has slowed 1.9%. Meanwhile, available capacity continues to expand. And what that means is that, like Vicky said, capacity is slightly exceeding demand. And back in July, demand spiked and capacity was added. However, importers completed their inventory building earlier than expected. So now airlines are stuck with this excess capacity. And C.H. Robinson summed it up perfectly in their market update as this has been a fundamental challenge of timing. To curb this effect, carriers aren't cutting capacity, rather, they're shifting it across routes. Capacity is down 7% versus last year on the Trans-Pacific route because of trade frictions and reduced demand, for example. And it's become increasingly clear that airlines are moving away from tariff-affected markets.
Mhm.
As we can see when we look at capacity route by route, Europe to Asia is up 19% year on year. Europe to North America is up 5%, and intra-Asian capacity is up 9%, according to IATA. In addition, passenger demand in Europe and Middle East is adding more belly hold capacity, and that's going to have downwards pressure on air freight rates.
Brilliant. Really interesting to see that regional variation there. And I mean, that's a lot to follow there. Obviously not shown on the chart, but of course, if you do want to access all that underlying data, then you can do so through the GACI dashboard, which has all of the data we use for this report in there as well. Okay, so that's the capacity situation, really interesting. And then we'll turn to fuel. So, what's the situation in aviation fuel? Janan?
Um, yes, jet fuel is always the point where things get a bit unpredictable. Globally, the average jet fuel index is up 13% month on month and 9% year on year, with North America again seeing the biggest jump of 16% year on year, while crude oil was actually down 9% versus last year, as OPEC gradually relaxed their production cuts. Jet fuel rose 5% to over $90 per barrel, and that was driven by tightness in the diesel market. Um, so what does this mean for 2026? Earlier this year, the market consensus was that prices would soften throughout the year and into next year. But OPEC is now predicting that demand will rise, as I said earlier, by 1.6 million barrels per day. And that would definitely put upward pressure on prices and by extension, air freight rates.
Brilliant. Thanks very much, Janan. Okay, so expecting upward pressure from fuel on rates, and then we'll have a look at really what you think is going to happen to rates as well. So again, this is our sentiment index. This time for air freight, works much the same as the ocean freight one, and we're going to launch our poll now to ask you what your expectations are for air freight rate development. So please do respond to that, and while you're doing so, Vicky will just take you through what this data shows from the latest surveys from TI.
Yeah, so globally, expectations remain optimistic, with almost half of participants expecting air freight rates to rise, but only moderately. And again, there are significant variations by trade lane. For instance, for Asia to Europe in Q4, the results and the sentiment leans toward an increase in rates, with a very big chunk of respondents, 63%, expecting rates to rise, but again, only moderately or slightly. And then on the Asia to North America, West Coast route, again, the sentiment is divided. We have 43% of participants expecting an increase, and then 50% that expect a decrease. So again, we're seeing a similar picture to ocean freight and knock-on effects that tariffs have on trade lanes.
Yes,
Yeah.
but really a mixed picture, I suppose, there. So let's see what our poll results say. Um, and also a mixed picture there, I'd say. So I think lots of uncertainty really is all we can say from
Yes.
that. But what do you
Yeah.
think, Vicky?
But they're broadly in line with our poll results, and I think Uh, the timing is also relevant because we are heading into the contract renegotiating season, and we know that carriers would do everything in their power to prevent rates from falling further. So that might also have an impact on the sentiment.
Yeah. Yeah. Yes, well, quite. All right. Well, let's move on then to our outlook as well. But like you say, Vicky, that in this case, actually, that's in line with our outlook again, really for Q4, um, at least. And so here's our air freight outlook. This works a similar sort of way, and as you can see, we're expecting this moderate rise through Q4, but then a dip into Q1 before the situation recovers from a rates point of view anyway through the rest of the year. Um, but just like ocean freight, it's interesting to look into what's really driving this. So again, I could just ask Vicky you to pick out a few key demand side drivers, which are driving this rate outlook for us.
Yeah, so overall, the shifts that we're seeing in trade routes and product flows should keep air freight volumes moving. And the seasonal shopping events have also been driving an increase in activity, leading to rate and capacity pressures. So as a result, rates should remain relatively stable or trend slightly upwards. And then looking further into Q1 2026, we should expect the usual slowdown of freight activities as the holiday season ends, and with inventories also being drawn down and the global economic activity remaining soft, air freight volumes should also remain subdued. And as a result, we expect that air freight rates will fall. But again, carriers might adjust capacity to prevent rates from falling too far.
Mm. Okay, thank you, Vicky. And what about that capacity then? Janelle, Vicky's just mentioned it, but what are the key kind of supply side factors leading to this outlook?
Of course. So we have tariffs, labor disputes, weather events, and capacity shortages that have created disruption on many routes. Generally, CTKs are on a downward trajectory since July, whereas ACTKs continue to expand, leaving a bit of excess capacity. And also, strong passenger demand means more belly hold capacity, and that is currently balanced by continued reductions in freighter availability. And freighter utilization should stay strong, and the existing fleet is expected to be used fully, particularly for time-sensitive and high-value goods. Going forwards in peak season, capacity is likely to have an upward pressure on rates and will level off as we go into the new year. And on the jet fuel side of things, fuel price forecasting right now is as much geopolitics as it is economics. Drone attacks on Russian energy infrastructure are escalating, and recently, Iran seized an oil tanker in the Strait of Hormuz, which channels approximately 20 million barrels of crude daily. And if that route becomes unstable, we're looking at potential supply shocks to jet fuel and therefore an upwards pressure on rates.
Yes, thanks for that. And actually, that one of the questions we've had was asking about what the Suez Canal reopening might mean for fuel prices, but that's another potential geopolitical challenge there. Which could put the pressure in the opposite direction again. So very interesting. All right. Well, thanks for sharing your views on rate development. It's really interesting for us. And again, if you do want to read more about all this, you can do so via the reports after this session. But this is now your opportunity really to ask any other questions that you do have for Vicky and Janan on the air and ocean freight market. So please do use the Q&A tool to ask any questions now, and we'll do our best to answer them. Um, the first one we have here then is what is the trend for air freight demand in Q1 2026? That I think is probably one for you, Vicky, if you can tackle that one.
Yeah, so as I mentioned earlier, we expect that volumes will come down in January simply because the holiday season, the peak season has ended, and retailers have still have excess inventory and will be really cautious at restocking. So the expectations is that air freight volumes will remain soft in the first quarter of 2026.
Thank you. Okay. Um, and then maybe one for you, Janan, here. Um, which regions are seeing the biggest capacity constraints in air freight?
Absolutely. So on one hand, we have Asia to Europe, which is under significant pressure, and rates are climbing because capacity is genuinely tight. There's redirected e-commerce demand pouring in, and there's not enough long haul uplift into Europe to meet that demand. And if you look at semiconductor hubs, particularly Taiwan, that effect is even more pronounced. Um, and lead times are stretching out significantly. Now, on the flip side, the Trans-Pacific is a completely different story. It's oversupplied right now, and carriers have been restoring capacity faster than demand is actually recovering. So rates are staying suppressed there. Same thing with Europe, with all that belly hold capacity coming back from passenger networks. So you've got this really interesting dynamic where some lanes are red hot and others are keeping rates firmly in check.
Mm. Okay, interesting. So again, you really need that more granular data to look at that. All right. There's a couple of sort of quite similar questions coming in here, which I'll try and combine maybe. But what approach would you recommend in procuring ocean freight contracts now? Should we rely on spots while the rates are falling, or try to secure long-term contracts? And these other questions, putting that in the context of um, sort of mixed inflationary and deflationary pressures. So, what's the best thing to do? So, um, that's the million-dollar question, really, isn't it? But maybe Vicky, you can have a go at that one.
Oh, yes, it's a tough question, interesting one, but a tough question to answer. Uh, because there is so much volatility, I would say I would lean more towards long-term contract rates, and especially now because rates have been falling and are um, usually lower, it is a good time to secure those lower rates now ahead of the contract renegotiating season. So yes, I'm leaning more towards longer term contract rates rather than the spot market, which is still quite volatile.
Yes, yeah, that's the challenge, isn't it? Um, and then there's also the challenge of how low will the rates go, and is it the right time? Do you try and negotiate and fix, based on what rates might be in 3 months and pull that in? So that's the question. But remember, our outlook is for rates to decline, but then pick up again towards the end of the year. So there's a window of opportunity, you might say here. All right. Next question then. How will the changes in the ETS scope affect freight rates? Maybe that's another one for you, Vicky.
Yes, so the ETS, the scheme was implemented in 2024, but only covered 40% of emissions back then, and then it increased to 70% of emissions last year. And then from January next year, it will cover 100% percent of the emissions that carriers emit on voyages between EU ports. So it is quite a significant change, and a few of the ocean carriers have already announced that they will introduce emission surcharges. So that means
Mm.
they are planning to pass on those increased costs to cargo owners. Um, and there were some carriers even announcing surcharges in excess of 50%, which is quite significant. But I think in general, carriers will adopt different approaches when calculating those surcharges, and we should expect a lot of variations and differences in the cost structure, mainly because of the differences in their fleet efficiencies, in their emissions profile overall. So yes, this should affect rates. Obviously, it will put pressure on rates, but I think ultimately it's the market dynamics that will determine how high those increases will be. I mean, if the market is quite slow, obviously that will force the carriers to reduce their base rates.
Mm. Yeah, interesting one to watch, really. And there was also, I mean, when it first came in, lots of talk around which ports of call to go to and how it might restructure schedules as well. So that, I suppose we may see some more disruption and changes coming out of that. Um, and that's another question we've got. I mean, we talked about this a fair bit during the session, but how will the reopening of the Suez Canal affect freight rates? Well, hopefully that will increase available capacity. So you would expect that maybe to have a downside effect on rates, but equally, again, it's more restructuring of supply chain. So it cause more disruption as well and cause bottlenecks and so on. What's your view on that, Vicky?
So yes, we've had several announcements over the past month or so from the carriers announcing that they're planning to return to the Suez Canal. We've had a CMA CGM that they sent a few ships just to test safety, and then Maersk also announced that they are intending to return, but then change course soon after. So overall, I think most of the carriers are still very cautious. Due to safety risks. But once they return to the Suez crossings, I think the impact will be significant because obviously the voyages will be shorter, and that will reduce fuel costs, which again will have a
Mm.
significant impact on overcapacity, and will push rates down. But I think it's very important to highlight here that because of this and the impact that it might have on rates, that we're not likely to see a full return to the Suez crossings, but the return will probably be gradual.
Mm. Yeah, yeah, I think there's a lot of reasons that would be how it plays out, really. Okay, thank you. So, and this is probably connected, but maybe a place to wrap up. Would be where do you see the biggest ocean freight capacity constraints? And that's probably one for you, Janan, to take.
So the sharpest pressure is on the Trans-Pacific, where capacity has been cut aggressively. Blank sailings, reduced deployments, and disrupted schedules. Um, it also drove a 30% drop in available TEUs in October. Even with some services restored after the temporary tariff pause, the lane is still defined by overcapacity relative to weak demand, and that's keeping rates under downwards pressure. Now, on the other hand, Asia to Europe is seeing the opposite dynamic. Capacity is abundant and new build vessels are entering the market, and there's low blank sailings levels. And supply has risen approximately 8% versus last year. Um, so that outweighs Europe's really muted demand, resulting in soft, stable pricing, and there was very limited upwards pressure on rates. And on the transatlantic, capacity is tight, but for different reasons. export capacity from the US Gulf Coast is constrained at only 3 weekly sailings, and there's port congestion in Antwerp and Rotterdam, slowing vessel turnarounds. And that has created some pockets of upwards pressure, even though overall demand is moderate.
Okay, brilliant. Well, thanks very much for answering those questions, both Vicky and Joanne. That's bringing us to the end of our session today. So if you do want to ask any more questions, of course, we'll be happy to receive them. Please get in touch with us. You can do so by contacting me with using the contact details on the screen there. And that will enable you to carry on a conversation with us, or indeed, if you want to go into more detail on any of this, we can certainly discuss that with you too. And like I said at the start, I will be sharing the reports with you after the session. I think I neglected to say that we'll also send the recording of the webinar out. So if you want to share that with any of your colleagues or anything, you're welcome to share it too. And all that remains then is for me to thank you for joining us, and obviously to thank Janan and Vicky for their expert insights today. So thanks very much, and we'll see you next time.